10-year Treasury yield surging past 4.3% this morning, the first time since 2008. This amid expectations of tighter policy from the Fed and other central banks. Philadelphia Fed President Patrick Harker becoming the latest voice in the chorus, and he says the central bank is not done with raising its short-term rate target. Our next guest says that we're already seeing some signs of deflation, but until that shows up in CPI reports, the Fed, they're not budging. So we're going to be joined right now. We are joined right now by JP Morgan Asset Management Global Market Strategist, Meera Pandit. Great to have you here with us on set today.
Thank you so much for having me here today.
Absolutely. So, all right, help us walk through some of the Fed speak here and how it's really influencing some of the broader yields that we're seeing as well over the course of this week.
If we've looked across the last 5 days, the S&P 500 is roughly flat, and yet the real story here is yields. We saw yields move just about 10 basis points yesterday, up between 5 and 7 already this morning. And the more and more we hear from Fed speakers, the more and more it is obvious that we are not quite at the point where they are ready to start talking about a pause. There's a lot of work still left to be done on inflation. And so what we see when we look at how the Fed funds futures market are pricing in where that ceiling is on the Fed funds rate, that's coming up above 5%. Just a month ago, we were below 4.5%. So as we continue to see this goalpost shift, that's going to mean it's really hard to put a ceiling on where yields go from here. And we're going to continue to see that volatility in both the rate market and within the equity market spilling over. I
would say we're seeing a lot of volatility in corporate America. You look at Snap here this morning, you're seeing a lot of earnings warnings this week. What have been some of your takeaways from some of the early earnings reports?
So second quarter earnings was very much better than feared. I think that we could see some of that in the third quarter as well. It's still very early days. I think what's interesting from an investment perspective is if we think about tech stocks in particular, they have essentially moved higher in tandem over the last 2 years. And then this year, you're seeing a lot more differentiation on the basis of earnings. So I think what that tells us is more broadly, regardless of the sector, we're seeing that management companies and management can make a difference in terms of how they are navigating the inflationary environment, whether it's higher costs or higher wages. And from a tech perspective, we're going to continue to see higher wages weigh on tech profits. And also, thinking about ad spend and various other areas that management companies need to be very particular about, managing that structure.
Is this sector just not going to work as long as the Fed is raising rates? I mean, you had Evan Spiegel call out on a conference call last night, higher cost of capital. He's not the only company dealing with that, and it's likely only to get higher in coming quarters.
Certainly the challenge across the tech sector is going to be higher rates, and we continue to see them move higher. So, when we see some of this tech sell-off, it's not only because of some of the different areas where earnings weren't as strong. It's also because those rising rates are going to continue to weigh on all tech companies pretty unilaterally.
Okay, and so within tech, that's social media side, but you've also got a ton of volatility within the semiconductor space, which had been one of the stalwarts as well in addendum to both the digital advertising services and social media in the bullish run-up that we had seen for multiple years. You take those out of the equation now, where is an investor to look at this point?
Well, we can't necessarily see that as all bad news. I think one of the things that we definitely glean from earnings season broadly, whether it's tech or outside of technology, is that we're starting to see that inventories are kind of where they need to be from a semiconductor perspective. As you've started to see that supply being where it needs to be, that is good from the perspective of inflation, because that means we can start seeing disinflation as it relates to supply chains, which have already broadly peaked and are starting to normalize. So I think we also have to take some of this bad news that is coming out of earnings as good news on the inflation front. And from an investor perspective, look, I don't want to lose sight of the fact that in the long run, technology does have access to a lot of those longer term secular growth themes that we are interested in, whether it's software or cloud computing, some of the even longer term themes like robotics and AI. So we certainly want to look under the surface, pay attention to what management is saying about the longer term prospects of their companies and their business models, because in some areas, it's not a bad entry point. I wouldn't go diving into the tech sector altogether while rates are still rising, but we have to start considering some of those opportunities for the longer term.
Where do you see those opportunities? Because I think a lot of folks that we've talked to over the past 2 weeks universally agree there will be some form of recession next year, whether it's mild, whether it's severe, whatever it is. That's the environment where people are going to have to pick their stocks.
We are certainly a bit balanced across different sectors because, again, we're looking at this from a very much a bottoms-up perspective. Over the last 10 to 15 years when you've had very low rates, most companies have been able to be successful because costs were low, wages were rising at a very subdued rate. Now that you're starting to see more differentiation there, higher rates overall, that causes more of a challenge where companies really have to think about pricing power, where they're seeing consumer demand, how they're managing things like inventory. So you're starting to see some opportunities there. If I were to think, broadly at a sector level, areas like healthcare look pretty attractive right now. We see that valuations are still pretty reasonable. From a profits perspective, in a little bit of a crosshairs in that some of the COVID testing and vaccine sales are slowing, and yet some of the elective surgeries are starting to pick up. And from a longer term perspective, while it is defensive in nature in the short term, in the long run, you also, again, have some of those access to longer term growth themes. Energy is another example that was very much more a tactical play that has become a lot more structural and strategic, just given the longer term challenges in energy supply.
All of that sounds a lot better than what we're seeing at Snap and Meta. We'll leave it there. Meera Pandit, JP Morgan Asset Management Global Market Strategist. Always good to see you. Thanks for coming to the studio. Appreciate it.
Thank you so much.